You want to know what are the best stocks to buy now? I've got 5 stocks that I think are attractive to buy at these levels and lower. Let's go. Okay, so first I want to talk about Taiwan Semiconductor. This is the ultimate pick and shovel play for artificial intelligence. You can see just today, second quarter sales rise 38.6% year over year and beat forecasts. Taiwan Semiconductor will report full second quarter earnings on July 17th, including an outlook for the current quarter. That's in 7 days. Of course, without Taiwan Semiconductor, you wouldn't have NVIDIA chips. You wouldn't have AMD chips. Tesla, Apple, many other names use Taiwan Semiconductor as the foundry that manufactures the chips. So we're talking about nearly 39% year-over-year surge in revenue for this June quarter, surpassing expectations and reinforcing optimism around AI-driven growth. We continue to observe robust AI-related demand from our customers throughout 2025. We reaffirm our revenue from AI accelerators to double in 2025. An investment firm, Needham, says it sees a pathway to $90 billion in artificial intelligence revenue by 2029 in 4 years. They have a buy rating on Taiwan Semiconductor and raised the price targeted 270 from 225. And he did note that there's potential for AI revenue to decelerate in 2026, but would pick up again in 2027. Looking at the profitability and Seeking Alpha, very strong here, A+ grade, 57.41% gross profit margin TTM. And you saw the growth, it's very solid. This revenue growth, 39.86% year over year. Now, valuation-wise, this is where it can get interesting. And for each stock today, I will look at some valuation metrics as well as a chart. So you can see the PE gap forward for Taiwan Semi is 24.70. That PEG gap TTM is 0.46. That's very strong. And the company does pay you a 1.25% dividend yield with a very low payout ratio. The free cash flow is very strong for TSM. Now, looking at the historic PE ratio for Taiwan Semiconductor, you can see that back here, say in 2010, 7.73. You can see 10 here. You can see a 15.93 here in 2018. In 2021, it got up to 25.83, fell off a cliff in 2022, down to 11. And now today, stock at all-time highs, the PE ratio 30.73, or near all-time highs. Again, I'll show you a chart in a second. But what this does tell you is that the PE ratio is the highest it's been on this chart since 2010. So we're talking about 15 years of data here, and this is the most expensive the stock has been from a PE ratio. Now, with that said, it's because the growth is very strong and there's AI demand. And again, this is the true pick and shovel play for AI. But when I see comments on X like, hey, Taiwan Semiconductor, it's dirt cheap where it's at because it's only trading at a 25 PE ratio, you need to look at the historic data as well. Looking at a chart, you can see that Taiwan Semi went to 226.40. This was in early 2025, fell off a cliff like a lot of stocks, especially AI-related stocks in April, down to $134.25. Remember that this is in Taiwan. It's going to have unique geopolitical risks, especially with China. And so it makes sense with tariffs with China. With all the drama going on, the stock would drop from 226 to 134. Well, you can see an epic bounce like a lot of names from 134 here all the way up to $237, $238 on this Fibonacci R2. So we are sitting pretty much around all-time highs for the stock. And you say, well, why would you buy it now? Would I prefer the stock lower? Of course. And we bought this in the community portfolio. We started buying it around $200 a share when on the drop, and we DCA'd all the way down. Probably didn't catch exactly 134.25, but we added heavily in this yellow circle right here. The reality is the market's tough right now. A lot of the growth names have ripped. And so when I look at valuation, yes, it's expensive based on the historic PE ratio, but a 24.25 with a solid peg, this will grow into itself rather quickly. It does pay that nice dividend as well. So this is really a kind of an up and coming DGIF stock. And I do think with time, you will see this stock over $250 probably later this year. As a long-term investment, thinking 5 years out, I think there's a lot of upside for Taiwan Semi from these prices right here, right now. So the last stock pick, we talked about Taiwan Semi being the ultimate pick and shovel for AI. But we like to talk about all growth trends. And really, when you think of autonomous driving, AI and autonomous driving go hand in hand. But this next stock is a Magnificent Seven name. And a lot of people still think this is undervalued. Now, there are certainly risks to Google. When you think about its core business, It's digital advertising. More on that in a second. But first and foremost, I want to talk about Waymo. So Waymo, you may or may not know, is owned by Alphabet. Alphabet is basically the parent company of Google. Waymo is heading to Philadelphia as well as New York City. Lots of expansion here, lots of opportunity. We did a video recently on the channel. We talked about AV, autonomous vehicles. Of course, Tesla, Nvidia, names like Uber could benefit, but Google Waymo is definitely a leader in the space. Now, here's the problem. Right now, it's only about 5% of Alphabet's total revenue, and this is saying by 2040. And this is according to Gemini, which is, of course, Google's AI. I wanted to show you this for a couple of reasons. Number one, I mean, this could be wrong, but right now, Waymo is a very tiny segment of Alphabet's revenue. So a lot of people, again, on X will say, oh, this is a great buy because Waymo's the future. Well, it could be. According to its own AI, it's only 5% of its total revenue by 2040, so some food for thought. The other thing I want to mention here, though, is one of the risks of Google is the fact that people are going to use chatbots like ChatGPT, maybe even an app like a Grok app that you download instead of going to Google and doing a search. So traditional digital advertising is being disrupted in that way. It used to be, instead of getting this overview, I would get a link and I'd click on the link and there'd be advertisements within those links. And of course, you can still go down and you can get those links and click on them, but a lot of people just go into their AI chatbot and ask the question and get the answer. Now, of course, you're watching YouTube, which is owned by Alphabet Google. So Alphabet Google has its hands in a lot of different pots. In the end, though, I want you to remember this: Meta and Google at the core, these are digital advertising businesses. They are very different than companies like Amazon or Microsoft. And if you watch my top high conviction video, you know exactly what I'm talking about. Profitability metrics on Seeking Alpha, you've got an A+, 58.59% gross profit margin TTM, bringing in about $600,000 per employee. This is net income TTM. Growth, now this is paying a dividend. So this is an up and coming DJIF stock. So it's not gonna have outstanding growth, but still a B. You can see about 12% forward revenue growth. It just started paying a dividend not long ago, and it pays you about a 0.5% dividend yield. Very low payout ratio. Valuation-wise, PE gap forward, 18.37, solid. This PEG gap TTM, 0.53. This is also solid. It's growing to its valuation quickly. Just for reference, a forward price to sales is 5.52, which I always find interesting. And even more interesting, look at the stock price up here. You can see that you're not at all-time highs. You're at $176 here on this chart. But this price is going up, and this PE ratio is actually going the opposite direction. It's going down. So this PE ratio here is 19.7 with a stock price of 176. And all the while, this EPS, earnings per share, is growing exponentially at the same time. So Google topped out at $207. Of course, it sold off like a lot of these names in April. Most tech got shellacked, went down to $140.53. And then bounced up to 181. You can see right now it's about $177 a share. In fact, it must be lucky it was 177.77. So is it the cheapest price you could have bought in 2025? No, not much is going to be the cheapest price. $140 if you sniper time the bottom. But what are some attractive stocks to buy at these levels of the long-term investor that could be worth a lot more in 5 years? Are there risks to Google? Absolutely. I mentioned some of those as I went through. It'll need to fight up to this R2. We're talking about $185. This R3 is 192 up here. And of course, with time, you're going to be fighting for those all-time highs, $201, $207. But remember, guys, this is more of a mature business. It pays a dividend. This is not in the hyper-growth stage at this point. Very solid numbers, and you're gonna make money more than likely over the next 5 years. Are you going to get rich from Google stock? Probably not. I prefer $150 or less DCA, but do I think it's attractive at $175 if I'm a long-term investor and I'm periodically dollar cost averaging? The answer is yes. If you're in our Patreon, you've probably seen these slides. I'm going to go through them really fast. I did a top 10 high conviction stocks for the next decade, and you saw these secular growth trends. We want to buy stocks that are riding trends like artificial intelligence, like cloud computing, digital transformation, e-commerce, digital platforms, and fintech. What's one company that can cover all of these? Artificial intelligence, cloud services, e-commerce. One company can cover all these secular trends, and it's one I'm very confident, my number one highest conviction stock over the next decade, that I'm not going to lose money. It doesn't mean it's going to perform the best or give you the best returns necessarily, but I can sleep well at night owning this stock. Can you guess which stock this is? One company for all three would be Amazon. that is pick number 3 on today's list. Considering this is a retailer, e-commerce, the fact that it has gross profit margin of 49.16%, this is very impressive. Now, the reason for this is going to be AWS, so Amazon Cloud Services, as well as advertising. So this has become a digital advertising behemoth. These are the two cash cows for Amazon, AWS and digital advertising. The growth is not going to be hyper growth. This is a mature company, multi-trillion-dollar market cap, part of the Magnificent Seven. So you're going to see something around 10% revenue growth. Now, if you watch that video on the highest conviction stocks, you understand that I think these profit margins are even going to get better, and they're already an A+. And the reason I believe that is because Amazon has over 1 million employees, and more of those employees are going to be replaced by artificial intelligence in the office and by humanoid robots and automation when you think of those warehouses, as well as delivery. So at some point, there's only going to be a handful of people in each distribution center. Most of it's going to be robotics. Many of them already are. In fact, Amazon has over 1 million robots deployed in its facilities currently. According to Gemini, 1.56 million people are employed by Amazon worldwide. Now, not all those people are going to be replaced by robotics and AI, but even if, say, 500,000, 1 million of these people are replaced, that's going to impact the bottom line, and it's going to increase that profitability. Things like free cash flow and so on. Now, valuation-wise, well, this is going to be more expensive than the last couple of stocks we talked about. The PE gap forward is a 35.81. But again, these PEG ratios are attractive. Of course, this is TTM at 0.5, but even the non-gap forward is a 1.99. These companies are growing into their valuations quickly. Amazon's up about 11.65% in the past year. Year to date, it's only up 1.45%. Now, of course, I preferred the stock when it was under $200. That's when we added it to the community portfolio. So when it got to $200, we DCA'd as best we could in this area. You can see the stock went from 242 down to 161. Now it's back to 222. I do think it'll fight back to this R3 Fibonacci at 236 and eventually those new all-time highs at $242. When I think of long-term investments, sleep well at night. This is a core foundational type stock that I want to have in my portfolio. All right, for pick 4, let's get into a little bit of a dicier pick. This is going to be controversial. It's going to be polarizing. You're either going to like this pick or you're not going to like this pick. I'm actually buying the stock. I bought some yesterday. I bought some more today. Now, this is going to be a better fit for a DGI type portfolio. You could certainly have DGI stocks in your portfolio for some diversification, but this is not a growth stock. With that said, it is beat down. This stock is down 40% year to date. When everything else is going up, this is down 40%. Any guesses? So UnitedHealth Group, UNH, this has a dividend yield of 2.93%. PE ratio TTM 12.64. You can see the 52-week high was $630.73. So you could have actually bought this at $600 plus and be down over 50%. Remember, guys, this is a Dow component stock, so being down 50% is a big deal. Is this an opportunity or a value trap? Well, of course, I'm buying it, so I think it's an opportunity. Could I be wrong? Sure. This next clip that I'm going to show you is from May, and the stock was $318 at that point, and he said there was nothing but upside from there.
CNBC contributor Jeff Kilberg is KKM Financial's founder and CEO. And Jeff, you own UnitedHealth, is that right?
I do, Kelly. It's an essential name. If you look at all the healthcare providers, there is no other company besides UnitedHealthcare that has figured out the pay collect mechanism. It's the biggest at $300 billion, and yes, it's been cut in half, down from that price of $630 just a couple months ago. But this is still an essential name. I know there's a ton of uncertainty, and it seems like, Kelly, it was a 1-2 punch. You had an imminent step down from the CEO, and all of a sudden they're going to cancel their forward guidance. So that 16% drop today on top of precipitous drop we've already seen. Look at the relative strength index. The relative strength index is at 15. It's a broken chart, but I think it's providing a great opportunity to own an essential name. We own the essential 40. I think it's nothing but up here. Once you see Helmsley, who had a great decade, remember, Kelly, he was up over 250% in his decade that he used to be at the helm of UnitedHealth.
Now, this morning, UNH was down to 296, and you'll see on your screen nothing but upside from 318. So it's been 3 months, and you can still get the stock $20 lower than what he's talking about here. So I added some more shares of UNH in my dividend portfolio this morning, looking at Seeking Alpha, profitability A+. Now, the gross profit margins, of course, is insurance, so it's not going to have like software margins. We're talking about 22%. That growth, of course, isn't going to be stellar because it's not a growth company. It's a Dow component. It's a DGI stock. You're talking about a 2.92% dividend, 15 years of dividend growth. 5-year growth rate of 13.64%. That's very solid. And that payout ratio is pretty low at 30%. So this is a strong DJI stock at these prices. The dividend safety is an A. I don't think that there's risk that the dividend's going to be cut. I think it's one of those things where the company is just fine. The stock's broken, but not necessarily the company. Are they going through some pains right now? New CEO? Yes, there are definitely things going on, antitrust possibilities and so on. But in the end, I think the company's still going to be around. It's going to be fine. In a year, a lot of people aren't going to remember, and the stock's going to be a lot higher. Valuation-wise, solid. You know, the PE gap forward, 14.38. That PEG gap TTM, 0.28. And everybody seems to hate it, yet it only has 1.29% short interest. So don't get it twisted. This is just going through some struggles right now. You're going to have earnings coming up. That could definitely impact the stock. The sentiment is very bad. You continue, this is just today. We got another article here, talking about Morgan Stanley, near-term headwinds for healthcare stocks. And Barclays just lowered the price target for UNH to 337 from 350. Although it's important to note, he retained a buy rating on UNH stock. Now, keep in mind, today is July 10th. Earnings are going to be July 29th. That can make the stock certainly go higher or lower. Overall, the highest price target on the street, 440. The lowest is 270, average is 360. So $360 is about 20% upside from today's prices. It's trading around $300 a share. So of course, this is a nasty sell-off. $630 all the way down to $248 a share. Now it popped up from that $248 low and it went up about $100 to $340, but then rolled back and now it's below $300 a share again this morning. When you think about risk reward and opportunities in the market, of course, this could have more downside risks. But we have this floor, we think probably around 250. Can it go lower than that? Sure. But you have a lot more upside opportunity than downside, which is the opposite you can say for most charts. Now, I'm not a fan of just looking at an ugly chart that's bearish like this and say, I'm going to go buy this stock hand over fist. For me, it's about fundamentals. And I have owned a small position in UNH since 2017. So I've listened to earnings reports 4 times a year for nearly a decade. And I'm confident this company will do fine longer term. Now, not everybody's going to share that same conviction. You might hate the company. You got to do what's best for you and your money and your portfolio. Up next, I'm going to give you a rapid fire 3-for-1. So I'm going to go 3 charts back to back. Before we do that, if you're new here, if this content's helpful, please subscribe to the channel, click that bell for notifications. And please do me a favor, drop me a like, drop me a comment. Let me know what stocks you're buying. Drop me a comment below. The first one is Berkshire Hathaway. Now, if you look at this chart, since Uncle Warren said he was stepping down CEO, the S&P 500's up 10%, Berkshire Hathaway down 11%. We got over a 20% gap here. Market's going higher. BRK is selling off. Is this an opportunity? I do think it's an opportunity. Of course, it can go lower. This trend line is going to be down here around 440. I don't think it's going to go that low. I would like to see the stock below 450 though, if possible. It's 476 right now. You can see 542, it kind of topped out. So this is a significant drop. It's below the 200-day moving average. It's filled most of this air pocket, not all of it, but it's at 475. I think it's a relatively attractive buy. The lower, the better. DCA. Bonus pick number 1 or stock number 6, BMY. Now, this is going to be more of an income stock, pays you over a 5% dividend yield, 5.2% dividend, 33% payout ratio, 17 years of dividend growth. With all stocks, when you look at a chart, it's about fundamentals first, 99%. That last 1% is going to be the technical analysis. In a chart, the stock can always go lower than what the chart shows you. But if you look at these candles right here, it is bullish. It looks like it's finding a bottom here around that $45 a share, or really closer to 47. Right now, it's $48. I think under 50 DCA if you're looking for more of an income stock. Again, 5% plus dividend yield. And the last one, I do think GitLab is still attractive. I prefer it under $40 a share. Right now, it's $45.61. The downside risk, if earnings are bad, you could see something like $35 on a high flyer name like this. The upside, you could see 55 plus. Even saw in the 70s here back in January of 2025, close to $75 a share. Thanks for watching, guys. Have a great rest of your day. Take care.